Hey everyone, welcome to this explainer on ACC 321, Chapter 4. If you're staring down that governmental accounting syllabus right now, feeling, completely overwhelmed by the sheer number of rules, exceptions, and obscure legal jargon, take a deep breath. We've got this. You're in the exact right place. Today, we're taking all that complex material on recognizing revenues in governmental funds and turning it into a straightforward, actionable study guide.
Let me ask you something right out of the gate. Are you sitting there trying to memorize every single revenue example for your exam? Because if you are, seriously, stop right there. In this explainer, we're ditching rote memorization. Instead, I'm going to give you a cheat code. It's a framework built straight from the source material, a simple, logical decision rule that'll help you tackle literally any transaction your professor throws at you with absolute confidence.
Here's the game plan for this explainer. We'll start with the core recognition rule, break down exchange versus non-exchange transactions, and navigate taxes and grants. Then, we're going to cover timing and deferred inflows, expose common exam mistakes, and wrap the whole thing up with the ultimate cheat sheet.
All right, jumping right into Section 1, the core recognition rule.
Now, there's a massive mindset shift you have to make right here. If you've taken standard business accounting, you're hardwired to think about profit, right? Business logic dictates that revenue is tied directly to earning. You sell a good, you perform a service, and boom, you record revenue to track economic performance. But governmental fund logic, it's a whole different ballgame. Government revenues often don't come from a direct exchange. Think about it. Taxpayers pay in, but they don't get a direct, equal value back in return. So you have to completely shift your focus away from profit measurement. Instead, it's all about accountability for current financial resources.
And that brings us to the golden rule of modified accrual. This is absolutely crucial, so lock this in. Governmental funds recognize revenue when it is both measurable and available. Measurable just means you can reasonably estimate the amount with reliability. Available means it's collectible soon enough to actually pay for current period expenditures. You have to separate these two tests in your head. Both must pass to recognize current revenue. If you know the exact amount but you can't use the cash yet, it fails the test. Simple as that.
Moving right along to Section 2, exchange versus non-exchange transactions.
There is a super sharp divide you need to understand here. An exchange transaction is your standard give and receive of roughly equal value. Think utility charges, parking fees, things like that. But non-exchange transactions, that's when value is given or received without an equal direct exchange. We're talking taxes, grants, donations, and here's why this is a huge deal for your exam. Governments rely heavily on non-exchange revenues. That's exactly why we need these special, dedicated rules for recognition.
Which brings us nicely to Section 3, navigating taxes and grants.
Okay, picture four main buckets of non-exchange revenues you need to distinguish. First, derived tax revenues. This is where the tax rides on an underlying activity, like a sales tax or a hotel tax. The tax follows the activity. Second, imposed non-exchange revenues. Here, the government doesn't tax an activity at all. It just imposes the revenue by law. Property taxes and fines fit perfectly here. Third, we have government-mandated transactions, like when the state requires a local government to use a specific grant for mandated service. And fourth, voluntary non-exchange transactions. Think willing donations with strings attached. Grasping this subtle difference, especially between taxing an economic activity and just imposing a tax by law, is a massive shortcut for exam day.
Now, let's talk about grants and their eligibility requirements, because the trick here isn't just getting the cash, it's whether the government is actually entitled to it. Purpose requirements mean you recognize revenue only when the specific purpose conditions are met. Time requirements mean, well, absolutely no recognizing it before the permitted time period. But here is the ultimate cheat code you need to highlight in your notes: reimbursement requirements. For reimbursement grants, revenue follows eligible spending. You recognize the grant revenue as you actually make the qualifying expenditures. Period. End of story.
Let's transition to Section 4, timing and deferred inflows.
Get ready for a major conceptual aha moment here. Listen closely. Cash received does not automatically mean revenue earned or available. I repeat, do not get fooled by an exam question where cash simply changes hands. A government might get cash in advance for a future period, or receive a big check before grant eligibility conditions are actually met. Yes, the cash goes on the books, but revenue recognition, that has to be delayed.
And that delay brings us to the absolute favorite trap of accounting professors, deferred inflows of resources. So what happens if an amount is measurable and the government has a legal claim to it, but it belongs to a future period or just isn't available to use right now? It is not current revenue, it's a deferred inflow. Think of it like having money in a jar that you're just not allowed to open yet. This rule protects the public from mistakenly thinking that future period money can be spent on today's services. If you know the amount, but you can't use it, your brain should immediately yell, deferred inflow.
Let's hit Section 5, Avoiding Common Exam Mistakes. Let's rapid fire through the top 5 frequent errors so you don't fall for them. Mistake 1, treating all cash receipts as revenue immediately. Nope, we just busted that myth. Mistake 2, ignoring the availability condition. Remember, measurables only half the battle. Mistake 3, confusing advance grants with current revenue. Again, cash today does not equal revenue today. Mistake 4, treating bond proceeds or transfers as ordinary revenue. Highlight this one, these are other financing sources, not revenues. They increase your resources, sure, but they aren't revenue from operations or taxation. And mistake 5, memorizing isolated examples instead of actually asking what type of transaction created the inflow.
Okay, we made it to Section 6, the ultimate cheat sheet. This is the whole shebang, your new framework-based approach in action. If an exam question says the revenue is measurable and available, bam! Your brain should immediately think recognize revenue. If it says measurable but not available, think deferred inflow. Cash received before grant conditions are met, delay recognition. What about a reimbursement grant? Remember our shortcut? Revenue follows eligible spending. And if you see bond proceeds, instantly classify that as an other financing source. Trust me, relying on this logic instead of panicked memorization is going to save you some serious points.
So, I'll leave you with this final, empowering question. Are you ready to stop memorizing endless, confusing lists and start actually applying the golden rule of measurable and available? Once you make that mindset shift to focus on accountability for current resources, the rest of governmental accounting falls perfectly into place. Thanks so much for hanging out with me for this explainer. Now get out there, apply this framework, and absolutely crush that exam.